Hey, welcome back, everyone. So today let's learn about what is an index and what is an index fund. So to start off, let's get our whiteboard out and draw this out. We're going to be looking today at our indexes and what they're. So just back up before we get into all the fancy schmancy stuff. What is an index? What does this word actually mean? Okay, not in the market, just generally, what does the word index mean? I'm gonna be your Latin teacher for 25 seconds. How about that? In, of course, self-explanatory. It means in or into something. And then dex, this comes from the root word to speak, to declare something, to point towards something. That's why you have your index finger. It's the one that you point with. Being dexterous means that you're good with your hands or your fingers. You have, dexterity. You have a lot of different words that come from these roots, but basically when you index something, you're basically using something to point towards something else. You're using it as a sign, you're signaling something, okay? So even back in the day, you had a Rolodex that was like this thing with all the names and phone numbers on it. And it was a way to categorize and compile and assemble all of the data, all of the numbers and names that were in that Rolodex. So an index is simply anything that you could use anywhere in life that kind of gives you a signal or a sign of what's going on. Okay, it's a signal of information. So let's do like a really easy analogy of this. I've got, let me get the camera back on. If you look at the camera, okay, I have a blue pen. I have another blue pen. I have a bluish marker with a red cap, a red marker with a blue cap. I think my kids did that. And then I have like another blue marker, okay? So these are all different products. They do different things, but let's say I got this for 50 cents US. Let's say I got this for 75 cents. Let's say this was $1 and this was $1. And let's say this was 20 cents, okay? If I wanted to know the general price and the movement of all of these things in a market, and the market would be people who are buying and selling markers and pens, okay? So the prices of these things should fluctuate year by year or maybe day by day if it was a really hot market. So instead of trying to sit down every single time and figure out how much this went up or down, how much this went up or down, how much this went up or down, what I could do is I could compile all of these into a data, into an index, and combine them. And I could call this the stationary index. Okay, this is stationary. This is things you use to write with, or the writing index. Okay. And anytime I wanted to know what the general movement and prices of writing stuff was, I could simply look up one thing. I could look up the writing index. And so I would have to figure out, do I want markers to be a bigger percentage of my index, or do I want pens? Well, it's going to depend on, what my motives are and how I want to figure this thing out. But generally, indexes are there to help us see what the general movements and ideas are in a marketplace. Okay, so I hope that analogy makes sense. I can figure out a lot just by looking at one thing, by compiling and averaging these and weighting them into an index. That's all that is. Okay, so let's get over here and look at the let's look at a real index. This one is called the S&P Standard & Poor 500. Is probably one of the most popular. And if you look at the S&P, it tracks 500 companies. They've got their reasons why they pick certain companies, different sizes, different industries. It's kind of across the board. It's a pretty accurate way to measure the American economy and kind of I would say Western economy mostly, because it tracks like it's very accurate in determining like Western countries, because it's a big part of it is going to be weighted in different sectors. So this S&P, if you look at it, the price is 4227.26. And this is your index that tells you how well this basket of stocks, this basket of companies, this representation, this index is doing. You can look at the 1 day, the 5 day, the 1 month, the 6 month, and you're getting data on what the general market is doing by watching this S&P. So when you hear on the radio, you know, these people saying, oh, the S&P was up or down, blah, 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 the Dow was up or down, the NASDAQ, each index like S&P, NASDAQ, Dow, they just track different things in different ways. But they all give you a general direction of the market. Like, let's look at the NASDAQ. I'll type in NASDAQ index. Should bring us up. There we go. So NASDAQ, same thing. Oh, that's not right. This has got a bug or something. That is definitely not it's missing some data point. Oh, let's see if we got it here. Yeah, I have no idea why it's doing that. Okay, so anyway, if we looked at the year to date, you know, you would get kind of the same picture as you would in the general market. However, the NASDAQ sometimes can be down while the other ones are up. The NASDAQ is more tech heavy. It tends to track a lot of technology and a lot of emerging things. And then you can look at the Russell. The Russell gives you the Russell 2000. It's like 2000 small cap, mostly small cap, and I would say some mid cap companies. So it's kind of giving you an idea of emerging things. You could say higher risk businesses that don't have as much capital, haven't been around as long, probably. This is a good indication of kind of the sentiment in the market in general, about, you know, how hot are people on the market, because the Russell is typically one of the first ones to suffer when there's a bear market, because people will pull their money out of small, medium companies and at least try to put them into large companies. So you'll see this one behave differently than the Dow. And you don't really hear as much about the Russell as much. It's not as popular, but I look at it a lot because I trade in a lot of mid-cap companies, small and mid. So one last one we could look at would be the Dow. This is the one that like everybody knows. And yeah, so you can tell like the Dow looks kind of just like the S&P and the NASDAQ, but there are some slight differences. Now, these are all indexes, okay? All this is telling you is it's pointing, it's your index finger, it's pointing to tell you a bigger picture of what's going on with a sector or a market or even a country. Let's look at the Dow Jones. I pulled this up. This actually tells you the weight, which means the actual percentage or how heavy something is within the index. So going back to my analogy of the markers and pens, okay, like I said, I could theoretically, if you look up here at me in the camera, I could weight these markers and say, well, I'm really heavy on I really am interested and I want to invest more heavily in markers because I think markers are more important for this stationary economy. I think markers are a bigger demand. I think that they're a bigger part of the picture. They have a greater influence on the price of everything, okay, on the general economy of stationary. So I want to give more weight. So I could, even though these were, what do we say, like $1 a piece, we could give them a weight in this general mix. We have 1, 2, 3, 4, 5 things. We could give these markers like a heavier weight and say, okay, well, these markers can represent 50% of the overall picture of all these things. So when markers move, it creates a big movement in the whole index, okay? Now, if you look here at the Dow, We have like United Health Group Incorporated, UNH. It's 7.6. So it means that like this thing's heavy weighted in healthcare, Goldman Sachs, finance, Home Depot, home improvement, housing, Microsoft, computers and tech, Boeing, travel and aircraft. So you'll see it like a huge percentage of the Dow is in like tech, housing, finance, and health. McDonald's, um, business infrastructure. And then when you get down here to the bottom, the smaller weighted things, the things that don't make as big of an impact in the Dow are like Cisco, Coca-Cola. You got oil with Chevron. And so, who made these decisions to make certain things more weighted in an index versus another? I don't really know. I'm sure you could look that up and figure out how they did it. I didn't make the decision. So again, one thing to always consider when you look at an index is, who made this up, right? Like who created this picture? And some people could say, well, it's tradition or it's experts or whatever, but it's like, well, who's an expert? I mean, this is why when you actually are trading in the market, you'll notice that sometimes your stocks will all be up and the Dow is down and the NASDAQ is down. The whole market is down and all your stocks are up, or the reverse. All the markets are doing really great and your stocks are sinking. So why is that? Well, because these indexes don't record everything. They can't give you the full perfect picture of the market. It's impossible to look at the Dow and the NASDAQ and the Russell and say, I know exactly what's going on in the market. Because, even if just one stock was up when all these were down, it shows that something is missing from this picture. Okay. There is too many stocks, too many kinds of investments, too many markets around the world, too many things going on for anyone to assemble some kind of picture with one index and say, this is exactly what's happening. This is totally accurate. It's just not possible. So the first thing I'm going to say about indexing is that it does not give you a perfect picture of the market, which means that sometimes you'll get lucky with an index and outperform other stocks. And then sometimes, and I would say more often, you are going to underperform the leading stocks in an industry, okay? Because like, let's say with the Dow, when you're only invested in these 30 companies, if there's like a really great building company that makes machines like Caterpillar, but it's not on the Dow, if you only are invested in Caterpillar, you're missing out on that opportunity to invest in the other heavy equipment stock, if that makes sense. So when you index, you give up your right to be like really to have like finesse in the market. You can't just like reach in and grab what you want. And you can't like play with it too much because you're stuck in this box. Okay. And again, you didn't choose the box. You did not make up an index. I think if you're following my channel, you probably didn't create an index. Okay. You're not that rich and powerful. So if you didn't create it, then who did? Somebody made that decision for you. They created this index based on their ideas. This company, this corporation created this index, okay? Or the market people created it. So just keep that in mind. So that's number one. The index it boxes you into a set amount of stocks, okay? A set amount of investments. Now, I think we understand what a index is. So let's see if now we can understand what an index fund is. Okay, so an index just points us towards something and gives us information. Okay, it's our pointer. It's pointing us towards a general idea. The Dow is a index that points and shows us what 30 of America's biggest companies are doing right now. Okay, for example. All right, so index, we got that, check. Let's look at index funds. Well, again, not to like make you guys feel like you're going back to like eighth grade or whatever, but fund, what is a fund? A fund is when you pull all your money together. Okay. Actually, in a small way, like when you and your buddies are hanging out and somebody says, hey, let's go get like drinks or whatever. I'll go to the store. Everybody chip in $20. Like that's a fund, And so it's easy to understand what a fund is, but what about in the finance world? Does it quite work that way? Well, it's not too dissimilar. In the world of investing, companies have created funds, and what you do with a fund is you pull your money together with a bunch of other people and you create a fund. So that's where you get mutual funds, index funds, all different kinds of funds. So, think of it like a pie, and like, let's say you had a $100,000 fund, and there was like, let's say there was 5 people, and let's say you had 25%. Okay, you put 25 grand in, your buddy puts in 10 grand, and then let's see, and then you put in, somebody else puts in like fifth. No, that wouldn't be quite 50, but you get the picture. Uh, and then there should be 15 left. So here's 15. So this is an ugly pie. You can leave some funny comments down below, but I'm not an artist, but I do trade. So imagine this pie of 100K. Okay. And you take this money and you pull it together and you go and just buy a bunch of different stocks. And, with a mutual fund, we'll get into this later. The mutual fund has an actual guy or a bunch of people in a corporation basically using all this money to trade how they want to trade, and then they give you back the profits or the losses. In an index fund, they're not really actively managed like they are in a mutual fund. So you and 100 million people put all of your money into, let's say, Vanguard. Vanguard, which they've got a lot of popular index funds. So you hand your money over to Vanguard, like let's say $1,000. Okay. And you put your $1,000 in there and you buy into this fund, meaning you throw your money onto the table and say, yeah, I want to be a part of this. Well, their company, their people, their managers, they're always having these committees and they're supposed to be professionals or whatever. And they're always like trying to mirror the index. Okay. So let's talk about index funds. So Vanguard, let's say that Vanguard S&P, which I think is VFIAX or something like that. VFIAX. Let's make sure that's correct. I'm gonna look here real quick. VFIAX. Yeah. VFIAX is one of Vanguard's index funds that try to mirror the S&P, the Standard & Poor that we just looked at. So what they're doing, okay, let's clear this off because it's getting confusing. What these guys are doing, here's these guys. Okay, they wear a hat because they're really special. Okay, so they are over here at Vanguard and they have these systems, they have these groups, they have these committees, they have all these ways that they figure out how to mirror the S&P. So they look at the S&P companies, there's 500, and these guys will try their hardest to buy all of the same stocks that are in the S&P, okay? So that's what they're interested in. That's what they promised you when you put your money on the table. You said, I want to invest my money in the S&P. I want it to grow just like the S&P. And they said, okay, we have an S&P index fund. We can do that for you. So they spend their time, because the S&P sometimes will switch things around. They'll add different companies. The 500 is not always the same 500. And sometimes they change weights and different things. So these companies, they spend their time trying to mirror that and trying to replicate it, okay? And generally they get it pretty much exact. So what happens is, because they have invested your little slice of money and 100 million other people's slice of money, exactly like the S&P. They went and bought every single one of those companies in the same way. All they're doing is copycatting, they're mirroring this index. So you know what an index is, and you know the fund is just your slice of money in a big pool of money. And so basically, when you say index fund, you are talking about pulling a bunch of people's money together to copycat an index of the market. So we copycat the Dow, we copycat the S&P, we copycat the Russell. That's all you're doing, okay? You're just mirroring this little indicator. Now, there are fees that are associated with index funds. You know, they're going to charge you money. I'm not sure. A big part of how they make their money is by charging you those fees, because I don't think they charge you a percentage of what they make for you. They just charge you fees. So that is something that kind of should make you scratch your head a little bit. Like, if they're so good at making money, then like, why do they have to charge you fees for like buying and trading? Like, you know, they should just charge you for how much money you make and then take a percentage away. Then they could make so much money because they're so good. But we'll get into why that's all just kind of not true. S&P 500. So what your account should do when you invest in an index fund is it should mirror the S&P. So you could just look at the S&P almost and kind of know what your fund's going to do over time. Okay. So if you got into it at $2,000 down here, you put 2,000 bucks in, and then let's say the S&P over 6 months goes up 10%. Then your fund, okay, this is not a stock, so it doesn't change the stock price. Your portion of the fund should go up just around 10%. So you should be able to get out of this at what? $2,200, because you made 10% from going over these 6 months from here all the way to here, okay? And it just simply followed this S&P. So I'm not sure there's much more to say about index funds other than, you know, you're not doing anything original here. There's no original thinking. There's no new ideas. You're literally copycatting an indicator, okay, a pointer, an index that's been created to try and give people information about a market, okay? So you can never beat the market with an index fund. No matter what anyone tells you, you might get lucky and there was a little bit of lag, or they bought a little too much of something and it happened to be in their advantage, the people who manage the funds. But overall, like, because by its very nature, it mirrors something, it can't beat it. Like, you can't beat something when you mirror it. You can only be side by side. So you literally can never do better than the market when you invest in an index fund, okay? And that's all I've got for index funds. And the next video will be about ETFs, and then we'll do one on mutual funds. So enjoy that. Thank you.